Right. Good morning, all of you. I expect to just discuss about the last presentation which we did at the last session. Anyway, before that, I want to just tell you something about the course. Yeah, you can. Right. Now, actually, we have started a very important type of session. Last time we are with regard to the operational risk management. And I want to just tell you the real importance of operational risk management for a financial institution, banking institution. And all other activities completely depend on the operational risk management of the institution. So that will really decide what would be the path of the organization. And the organization can really achieve very successful results if they do the operational risk management in a proper manner. So therefore, this is very important, and it doesn't mean that others are not important, but you can really get the base through the operational risk management. If you have the base correctly, the other things will have a automatic existence. So with that, I want to just explain, or I want to just start the things today. And I think last time we started discussion of internal loss data. That is the primary part of operation risk management in the institution, because through that exercise, the employees, the members can have a sense of the operational risk management, because through the internal loss data, when it is reported, all the people or all the staff members in the institution would get a certain idea about what type of risk being exposed to the organization. So therefore, this is very important as the preliminary activity. So therefore, in a practical sense, you all should get an idea. It is not just the theoretical parts, but you have to have your own skill to apply these things into your organization. Sometimes you may not be in a decision-making level, but soon you would be in such a level. So then you will get the skill where you can extract and have a database on losses in the organization, operation losses in the organization. And for that, we need to be aware about the different business lines in operation and the different risk event types. When you have these different risk event types, you should be in a position to understand those things. So therefore, the classification of the operational losses into the loss database has to be done by the center organization with the knowledge of operational risk. So therefore, the reporting task would be done by the ground level people, where the database maintenance has to be done by a central department. Otherwise, there would be some confusions in the categorization. Right. Now we will go to the presentation. Internal loss data capturing and maintenance. Now, through this presentation, I will explain you the way in which you can do this exercise. But the different organization, in different organizations, this exercise has to be done in a different manner, because that all depends on the organization's culture and the structure. Therefore, you should be in a position to devise a methodology to do this capturing in your organization. Sometimes you may have hands-on type of activities for this, but nevertheless, you should have some thinking process at least with regard to your internal loss data capturing exercise and what is the most appropriate way of doing it as per the organization's culture and the setup, the structure. Now, these are the key points. And in the key points, the categorizations given with regard to the risk types: internal fraud, external fraud, employment practices and workplace safety, clients' products and business practices, damage to physical assets, business disruption and system failures, execution, delivery, and process management. Now, all these things come into a categorization where we call them the risk event types. Now, if you take these things into consideration, you, in a basic way, you are in a position to categorize these events into 4 basic areas. Now, in the operational risk definition, it really covered the unsuccessful or failed internal processes. That is one area of operational risk exposures. Failed or unsuccessful internal processes. Then failed or unsuccessful systems and failed or unsuccessful people's activities and from external events. So if you take these 4 areas, you should be in a position to categorize all these risk events into these different sources. Now, for example, if you go into internal fraud, so how are we going to put it? In which area? You can put it into the people's activities, failed or unsuccessful. Even though we call it failed, it may not be a failure on the fraudulent people's side, but in the organization's perspective, it is a failure. So therefore, internal fraud comes into the people's activities, failed or unsuccessful activities through the organization's perspective. External fraud also taken as that type of a thing. Employment practices and workplace safety, it comes to the, when you say practices, it comes to the processes. Clients, products and business practice, that also comes to processes. Damage to physical assets comes to the external events. Business disruption and system failures come behind systems. And execution, delivery, and process management also come into the process. Now, I think that broad categorization is not that difficult. Policies and procedures are needed to set minimum criteria for loss data collection. Now, what do you mean by minimum criteria? Now, when you collect loss data has to be collected, but the database should have losses. There should be a minimum loss to be reported. All the losses cannot be reported because there are some losses which are not in a say considerable amount, so it is very negligible. So if you do that, then you will have a overflow of information. So in order to just avoid that, what we can do is we can decide on a minimum threshold to report. But that doesn't mean there's no record on those things, but the records are there, but it will not go into the loss database. That is the only difference here. That is why it says threshold for mandatory collection, calculation of gross and net amounts. Because sometimes the losses through the operational activities could be mitigated through some type of insurance or that type of things. Then gains, near misses, and opportunity cost. So that's a different aspect. Near misses. So that is also to be reported. Accounting adjustments, recoveries, selection of appropriate dates, timing of including legal events, treatment of legal fees and reserves. Now all these things come to the big list of procedures, allocation methodologies, boundary events, action taken of mitigating activities, non-financial impacts. Now all these things will have to look into. With regard to the data elements. And the database should be arranged through IT. And those things to be integrated with the operational risk framework. Now, all of you should go through this and get an idea about what this loss data is and how to manage and how to maintain a database. Now, when you take into consideration this event data, it is not just losses, but broader category of operational risk events. There can be internal events or external events. That is why we have two categorizations of internal loss data and external loss data. So therefore, since the organization is in the system, the overall system, external events also are important in order to get an idea about the operational risk. That is why we have given consideration on external events also. Now you can see the structure of it. Now in black lines you have the culture and awareness and policies and procedures. Now these things will give you the base. On that base you do this, all these internal loss data capturing and external loss data capturing and having a database. All these things will based on the organization's culture and awareness and the policies and procedures. So, but there are three other things to be discussed. We will do the discussions during the course of the session today. And now our discussion is on internal loss data and external loss data. Now these are the reasons for collection of operational risk event data. I think this is a very basic type of a thing where you need to understand, because if you deal with risk events, you will get an idea about what type of risk events are very much frequent in the organization. And you can have a analysis on these events, each event. And the categorization of the risk events to different categories and looking at its intensity and the frequency. And that will give you a good idea about the direction of the organization with regard to the operational risk. So with that knowledge, you can do a fair assessment of operational risk faced by the organization and assign appropriate level of capital. So that is what you mean by capital modeling purposes. So that is coming through the quantifications. So in order to quantify, you need to collect appropriate and adequate amount of data with regard to the operational losses. Then the second thing is the identification of control weaknesses. So that's a very important point in terms of the organization, because in the organization there are accepted practices with regard to the controls. Only thing is there are set procedures for any type of an organization, but the issue is those procedures are not followed. So that is why these control weaknesses arise. So therefore, this operational loss events data collection will give you an idea about the weaknesses of control, in which area the controls are weak. So that is what you can look at through the operational risk events. Then with regard to the operational loss events and the trend of these operational risk events, you should be in a position to devise a mitigation program. Then understand their current operational risk exposure and any areas of excessive risk. So that is why I told you earlier, in order to have an idea. So idea means risk quantification is coming through the intensity of the risk that is given in rupees, in rupee terms, or we call it impact, and its frequency. These are the two factors which you have to look at in order to get an idea about the level of the operational risk. The level depends on the impact of the risk and the frequency of that. So in that way, you should be in a position to identify the operational risk. So what we can do is, when you want to see how you are going to control these losses or mitigate, so in order to do that, you need to mitigate the impacts and the frequencies, or you have to control that. And the last one is the most important thing, which you can inculcate among the minds of the people. That is what you call embed the operational risk discipline. Now, embed means that discipline has to be really put into the minds of the people, and then it will become a voluntary act. The discipline would be there in the minds of the people. And that discipline means you have to look at everything in that perspective. And all staff members should have this concept. So that is what you mean by embed the operational discipline. So it is not an easy task, but with organized activities, set procedures, you will be in a position to embed the operational discipline among the minds of the staff members. Now you can just look at it. Who should collect the lost data? Now there should be a person who is specially designed for that, designated for that. So that is why that's the person who call departmental designing. Or sometimes the lost data collection is responsibility of each employee, because no one can say that I don't have a responsibility to report it or whatever. So therefore, everyone is responsible for the reporting. If you see it, you must report it. No, that is the underlying principle. But it is not associated with any faults. You are not going to find fault with anyone. But you have this you have observed something and you report it. That's all. So therefore, it is not that you are going to find in fault with someone else. So this is the culture you have to really inculcate. It doesn't associate with the fault. But if you see something, some type of discrepancy or whatever, and it can be reported. So why we are going to do that? Because we can really get the idea and we can do the needful as far as possible, as quick as possible. Right now you can just see the indication where in a lost data collection program, what type of data you are going to collect and what should be collected. Right. So any event that meets a firm's definition of operational risk. Any event. If any event can be categorized under operational risk, so that has to be reported and it should be collected. Now these are the types of things or risk event types in which you have to collect data under these events. Right now, I think this will give you a certain explanation about each and every risk event, and we will go through that and see what is the real meaning of this. Right? I think internal fraud. Now, when we say internal fraud, we call it the event type category is level 1. That is the most general type of thing. Then you have the definition. And when you say internal fraud, it is the level 1 type category. Risk event type level 1, we call it internal fraud. And what do you mean by internal fraud? Losses due to acts of a type intended to defraud, misappropriate. I think I don't need to give so much of explanations. You all know what is internal fraud. But only thing is, now here the most important thing is, when you categorize internal fraud, at least one staff member, one internal person should involve in that fraud. If that is so, we can categorize it as an internal fraud. Now when you go to external fraud, now there what is the demarcation, it should be a third party. No involvement of internal staff members. So such frauds are taken as external frauds. Then you go to the third category, that employment practices and workplace safety. There you get the losses arising from acts inconsistent with employment, health. Now, because any employee has a code of ethics or code of practice, if those people have gone breaching these things, have gone against that, so that comes under employment practices and workplace safety with regard to that. Then the workplace safety also. Now, if you have not followed the safety regulations, that also comes into that. And sometimes organizations, they don't have safety measures, and if employees been victimized with certain damages or certain type of injuries, then the organization has to pay compensation. So that is coming under employment practices and workplace safety. Even discrimination events. Now, there have been in internationally, you can see in certain organizations, they sue the organization against discrimination. It can be done racial discrimination or gender discrimination. Or likewise, you have several type of allegations. Now, through that such allegations, if compensation has to be paid, so that will come onto the employment practice and workplace safety operational loss. Clients' products, then the next one, clients' products and business practices, losses arising from an unintentional or negligent failure to meet the professional obligation to specific clients. I think this type of a thing is very much frequent in banking and financial organizations. Failures, negligency, and most of the time the bankers, they have been sued against negligency. So bankers' negligence. So that is a certain type a banker has to really accept. So all these clients' products and business practices come under that. So damage to physical assets, that's very simple. Business disruption and system failure, that is also, you all can understand what it is. Then execution, delivery, and process management. Process from failed transaction processing. Now this is very much related to the processing, especially the transaction processing. Right. Now I think you have to be clear about these things. There are 7 risk categories, and we call them level 1 risk categories: internal fraud, external fraud, employment practices and workplace safety, clients' products and business practices, damage to physical assets, business disruption and system failures, execution, delivery, and process management. Now all these things are called level 1 risk events. Right. Now we will see. Now we just start with the internal fraud with more explanations, more descriptions. Now, as I told you earlier, the internal fraud, when you say internal fraud, it is a level 1 risk event type. Now, what the definition for internal fraud, then you can just see what do you mean by level 2 coming under internal fraud. Now, under internal fraud, you have another subcategories. Those are called level 2. So, in that category, you have unauthorized activity, theft and fraud. All these activities are coming under level 2. Now, what is the level 1? That is internal fraud. And level 2, you get another categorizations, unauthorized activity and theft and fraud. Either if you do unauthorized activity also, you can put it as a fraud. Now, what do you mean by that? Now, say, for example, you don't have any authority to overdraw an account. Say you have overdrawn an account on your own, and that is an unauthorized activity. Either you might get the financial benefit or not, that's a different case. But since it is an unauthorized activity, it is taken as a fraud. So therefore, unauthorized activities also being taken as frauds. Right. Now, just to check the unauthorized activity, what are the types of unauthorized activities explained here? The one unauthorized activity is transactions not reported. So there has to be a certain report on different transactions. If you have overdrawn an account, you have to report it. So if you are not reported, that is intentional activity. You intentionally not reported it. So that is what you mean by transactions not reported. Then transaction type unauthorized. So unauthorized transaction, if you have done, then that is another fraud. That is also coming under unauthorized activity. Then mismarking of position. So that means mismarking means now you have just did the position in a wrong way. It is intentional. So that is also coming under internal fraud, and level 2 is unauthorized activity. Now, when you give these examples, now as it is, you say transactions not reported, it is intentional. So that is the level 3 example. Now I will just repeat that. When you talk in terms of internal fraud as the operational risk event, when you say internal fraud, it is the level 1 risk event. Now, internal fraud can be divided into several other factors, that is unauthorized activity and theft and fraud. So these two things are coming under level 2 of the of that particular risk event. Now, if you go further, under unauthorized activity, you will have transactions not reported, transactions type unauthorized, mismarking of positions. Those are coming under level 3 activities or level 3. Those are level 3 activity examples. Now, I think that gives you a certain understanding with regard to the categorization of level 1, level 2, and level 3. Level 1 means the most general one. That is the most general one. Then if you have a subcategories, the second level, we call it level 2. And if you have further categorization, you can say it is level 3. I think that is fair enough, you can understand. Then even theft and fraud also come in under level 2 category. And fraud, theft, misappropriation, malicious destruction, forgery, check kiting, smuggling, and all those things are coming under theft and fraud. So these specific things will come under level 3 activities. Now, when you say external fraud, that is the level 1 loss event, level 1. Now, when you say level 2, external fraud also you have the same categories, theft and fraud and system security. These are the two second level categories under external fraud. And these are examples. You can have so many other things which can come under level 3. of external fraud. Theft, robbery, forgery, check kiting, and under system security you have hacking damage, theft of information, or that type of things. Hacking, or you can have a virus, put in viruses and all that comes under system security. So that is also coming under external fraud. Right, now we went through two risk event types. Those are internal fraud and external fraud. Internal fraud is taken as a level 1 risk category. External fraud also taken as a level 1 risk category. Level 2 means the subcategorization of internal losses. There you have theft and fraud and unauthorized activities. So that type of things can come under level 2. So unauthorized activities and theft and fraud, that comes under level 2. Then if you have further specific activities under unauthorized activities, so that can be taken as level 3. I think these you can understand these things, I think. Employment practices and workplace safety. I think it is very much important for you to go through each and every risk event type and having an idea about the level 1, level 2, and level 3. Now, losses arising from acts inconsistent with employment, health or safety laws or agreements. Now, that means, what do you mean by inconsistent? So, you need to follow some processes. You need to follow employment practices. If people are not following that, people are not following the health regulations. So, all these will put the institution into trouble. And sometimes the diversity and discrimination events, that also can come under employment practices and workplace safety. Now, when you say level 2, there you have the employee relations, safety, environment, and diversity and discrimination. And all are coming under level 2. Employee relations, safe environment, and diversity and discrimination. Now, level 3. Now, under employee relations, the bank will have to pay compensation, some safety breaches or whatever. So compensations, benefits, termination issues. Then under employee relations, you can have organized labor activity. That means strikes and that type of things. Where you organize labor, there can be labor organizations, labor unions. Those activities also come under employee relations as a level 3 activity. Then general liability, slip and fall. So that is, the organization has to they have to take the responsibility with regard to the workman's safety issues. If they meet with an accidents during their work time, then the organization has to pay compensation, workers' compensation and all that. That is coming under level 3. Diversity and discrimination, all discrimination types. So there you have racial discriminations, then religious discriminations, gender discrimination, and all sort of things. Now, I think these things we should not, if you try to explain all these things, there will be so much time consumption. So therefore, what I want to tell you is you can literally read these things, and I want to just show you the way it is been given. You should understand what do you mean by level 1 risk categories, risk event types, and level 2 risk event types, and level 3 risk event types. So level 3 basically the activities, specific type of activities. Level 2 some broader categorization, Level 1 is the highest level or general type of categorization. Now you can go through this and get these examples and understand what it is. Now I can just give one example here. Now under clients, products and business practices, under level 2 you have suitability, disclosure and fiduciary. So suitability means how suitable the products are, that type of thing. Now that is level 2. Under level 3 you get accounting, account churning, aggressive sales, breach of privacy, and all those things can come under activity examples. Now when you say breach of privacy, now in banking you have a thing called confidentiality. Now if some bank has breached that confidentiality, that will come under clients, products and business practices risk event. That is the level 1 of that. And when you say breaching the privacy of a customer or breaching the confidentiality of a customer, can come under level 3, clients, products and business practices. Damage to physical assets. I think that's a very easy type of thing where anyone can understand. Losses arising from loss or damage to physical assets from natural disaster or other events. So that is coming under external events. But when you say level 2, disaster and other events, examples are natural disaster losses, human losses from external sources, terrorism, vandalism, and all that. Here also, now category 2 is systems, hardware, software issues, telecommunications, utility outage, disruptions, electricity failures, power failures, and all that. That comes under level 3. Now here also, this is understood. Right, now we will go to the next one, that is minimum loss data standards. Now there should be a clear policy in the organization. Yes, any question? Minimum loss data standards. It is important to have a clear policy and standards on the minimum reporting requirements for operational risk event data. Now there should be a criteria on reporting standards. The loss data standard should contain those data requirements that have been selected to facilitate strong operational risk management practices at the firm. Now it's like this. Now you should,
sir.
Yeah.
So if there is a cash excess or short, what will be the reporting?
Yeah, that is actually coming under process management, execution, delivery, and process management, cash excess, because that is some discrepancy in the process.
Even excess also should be reported.
Yeah, of course.
Okay, sir.
So because that is coming under that risk category, so I think that is understood. The risk category is execution, delivery, and process management. Because now the cash excess is a result of what you have done. Now you really engage in a transaction, and that engagement was not very not correct, and you made a mistake in that particular delivery. So that is why it should come under execution, delivery, and process management. Cash storage.
Okay, if there is a loss from reprocess and sold vehicle, should be no, sir. If there is a loss from reprocess and sold vehicles, should it be reported as a loss, internal loss?
repossessed vehicles. No, now there are, yes. Now you need to understand there are two different
Hello,
ways
sir.
of getting it. Now that loss can be taken as a credit loss.
If there is
Yeah,
a loss from
yeah.
repossession,
Because if it is repossessed and whatever, now that comes under a separate form. No, it is not operational type of thing. It is a credit type of thing. No. Now, why you repossess? It is a security, is it? Now you repossess means it's your security. Now you repossess it. But if it is a failure of your process, then it can be taken as an operational risk event. But if it is not operational failure, if it is a credit risk or whatever, so then it can go under credit risk. I think this is a very important question you asked, because when you say repossessing or whatever, so that really come in under risk mitigation process in credit risk, because you have obtained the vehicle as a security for your leasing or your whatever credit facility. So what do you mean by repossessing? Repossessing means you really acquire the security, right? So you acquire the security, and after that acquiring is coming under credit process. So, but if you have done any mistake in that acquiring, or you made a mistake, or you just had some unwanted type of thing in that case, so that comes under operational. Otherwise, it can be, now it has to be accounted into a credit loss, if that is the case. So otherwise, say if there's anything wrong in the process, then it goes to operational risk. You get my point? Now, when you say repossessing, that is coming
yes, sir.
under
Thanks.
security, dealing with the security. Right. I think you all can have this type of, now when you have some type of unclear area, you can ask the question, then we can put it clear. So I think that is the best thing which you can do, because this is a very practical type of thing where I think most of you might face with this type of issues in your day-to-day activities. So therefore, you need to clarify these things. Right. Now, when you say the minimum loss data standards, there you have two things. One is there should be a minimum loss amount to be reported, and there's another minimum to be taken into the loss data base. But that means you can have a reporting should be given to even a smaller type of a risk or loss you have to report. Then you will know where it is coming. But into a loss database, if you put, you have to put the, you have to just decide on a minimum threshold to be reported as to the loss database. So that is what it says here. Minimum reporting criteria is mandated by regulation, the reporting criteria. Then plus those data requirements that have been selected to facilitate strong operational risk management practices at the firm. So that means to put into the loss database, you should have another threshold. All losses has to be reported, but you should not put into the loss database all things, but you need to have a minimum threshold for that reporting. That is why we say comprehensive. It should be very comprehensive. Capture all material activities and exposures from all appropriate subsystems and geographic locations. So this is a, this has a very high span. All over the organization, it has to be implemented. Now here they have given an example also. Loss data program must include that all material losses. Now the word material is very important here. All material losses. And benefits and challenges are zero. Now threshold, now if you don't have a threshold, so everything you have to report. So, but in different organizations, there have been different threshold requirements. Varying thresholds are also there because for different types of risk types. Balancing risk management against capital data requirements, for that also you can have this type of thing, but that all has to be declared in the operational risk policy. Either you can go for a loss data program materiality criteria, or you can have thresholds for different sectors, whatever the way. So that all depends on your organization's requirements. Now you can see each loss data entry must include the loss amount. So I think this is a little challenging activity, because it is not that easy for anyone to tell the amount of loss at a certain point. But there are some losses incurred, even though the incurred loss is that, but there can be a higher loss at a later stage. So therefore, the loss reporting would be a little challenging, determining the true amount. And it says the gross versus net. The actual gross loss amount will often be different from the net loss amount or the loss after all recoveries. So I think this is a certain issue here. Right now, there are criteria for getting the gross amount also. It is as for the market value or replacement cost, or indirect charges, cost incurred as a consequence of the event, provisions, pending loan. Now, there are several criteria to get into this loss amount or gross amount. Even indirect costs you can take into account. Now, I think your question, I think you asked about excesses, cash excesses. Now, here there's a way to report it, gains. Most loss data programs also collect gains that are realized due to operational risk events. So actually, the excess is also an operational risk event. But that is, even though it's a gain, ultimately it is not a gain. It is a reputational issue sometimes. Now, all these things are adjustments, and that is understood. We will just see the way it is being done in an organization. Now, all these things are the details of it. Now, what I want to show you is a separate type of wait. No, what I want to show you is there's a small matrix where you can see how the things being reported like, because it is a I mean, very simple account of these things. Now, all these details are very much important, but what I want to tell you is you need to have a mental picture on these things. I will show you what to do there. And I think you need to have an Excel sheet or whatever in order to report all these losses. So as it is, I will try to explain it on the board. Right. Now I will show you a particular sketch of a loss data matrix. Now you can see that. Now we call it a loss data matrix. Now in this horizontal line, you have a business line. The vertical sense you have risk events. So 1, 2, 3, up to 7 risk events. Then you have 8 business lines. Now I think this is a very simple in the Basel document. Now we have gone through the 7 risk event types, and you should know the 8 business lines also. Now in the business line, retail banking, commercial banking, then you have treasury and sales. Likewise, you have 8 business lines. Now altogether there will be 56 cells here, because 7 into 8. You will have this type of cells, 56. And for each cell, you have another type of area where you have to report the frequency. Now, for example, say this is say internal fraud, right? Internal fraud, number one risk event type is internal fraud. Now, number one, say the business line is corporate banking. Corporate banking is the business line. So if something goes, some internal fraud happened in the corporate banking business line, so it is to be reported here. It is to be reported here. So number one business line represents the corporate finance or corporate banking. Number one risk event is the internal fraud. So if internal fraud happens in the corporate banking business line, that has to be reported here. Now say it is amounting to 20 million rupees. So then you have to put 20 here and 1 here. If another internal fraud reported from the same business line, what will happen is to add to the value here. 20 million not the value, no. So say again another 5 million is reported from somewhere else in the same business line. So then it will be 25 after that. And the frequency will be 2 here. So the number of events being reported here, amount reported here. So that is how this loss database is maintained. So by that, you will after a certain period of time, you will be in a position to take this data, the amounts and the frequencies for each business line and risk event. So that will give you a certain database to get some idea about your operational risk profiles. That is the necessity of this loss data capturing exercise. Do you got my point? Now, have you got my point? Because this is very important. Now, practically you need to do this. You can have a Excel sheet for this. And under the reporting, these business lines you can have, and the risk event types you can have. And when the loss is reported, you can have the categorization and you update the amounts and the frequencies. So likewise, you can maintain this loss database. Now, for example, say in the first cell, you have 204. That means 200 million is the amount of loss happened in business line 1 and risk event type 1. And what is the frequency? How many times it happened? 4. That is the number of times. So if you do it for 1 year, then for 1 year you can see in the risk event type number 1, that is internal fraud.
Sir, can you zoom to the board, please? We cannot see the board, sir.
You can't see it now.
Not clear, sir.
Okay, right. Now you can see, no? Now it is only a sketch. Now what I want to tell you is this side. This side represents the risk events. 1, 2, 3, 4. I put 1, 2, 3, 4. And this side represents the business lines. 1, 2, 3, 4 up to 8. So there are 8 business lines given, and there are 7 risk event types. So I just put this example as for a particular year end. You have say risk event type 1 is internal fraud, and say business line 1 is the corporate banking. In the corporate banking business line, there's a fraud, internal fraud. So these types of things being reported within a year, say 200 million. That is the total of internal frauds happened in the corporate finance, corporate banking. And how many times it happened? 4 times. So I'm just giving an example, right? Now, after a year of time, if these records are there, so that gives you the understanding that during the year, under internal fraud, the loss was 200 million in the corporate banking. So how many times it happened? 4 times. So likewise, you can get any type of a business line and any type of a risk type and see what is the impact and frequency of risk. So that is the real worth of having a loss data matrix, we call it. Loss data matrix. Now in a loss, yeah.
Sir, if there is a loss and recovered from same customer, should it be reported?
Yeah, that's the thing. Now in your loss data reporting procedures, they have given, I mean, in those slides, it has been explained. Now, what you have to do is, initially you can report the loss as it is. But if you have any type of a recovery during a certain period of time, so that recovery also to be incorporated and that has to be deducted at a later stage. So that is the thing. Now it is it's a very challenging thing where you don't know whether you can recover it or not till sometimes, no. But
no, sir.
You can. Yeah.
For an example, today we created a loss. Tomorrow we recovered the total 10 million.
Then it should not be reported. I mean, say then it's a type of self-correction, no. Either you can report it as a loss and then you can say recovered. That is a different case. But it is like this. Now say, as it is, say if you can recover it within a day or 2, I don't know whether it can be reported. I mean, in your organization, in an unofficial manner, people do this type of things. For example, say you make a excess payment for someone, and you can't say it is a loss, no, because that person you might recover it. You might recover it during the day even sometimes. Then it may not be reported, no?
Yes, that is the same thing I am referring.
Yeah. So I don't think that it is to be reported, because that's it is really going out of your official things. You do the settlement among yourselves. But only thing is, now if it is say, if you cannot really make the things during the day, you should have to report, no?
Even though we recovered, it is a risk even, no?
Yeah.
Exactly, sir. So it will become, I mean, it will be adding up to internal fraud, so if you don't report, sir.
If you
direct manner,
it will become internal. Yeah. But anyway, during the day, I mean, if say, because what I am telling is the practical situation. During the day, if you are in a position to really make it good, it's okay. But even in audit point of view, there's a big issue, no? I mean, people sometimes, you know, in some organizations, people give cash to another person in the morning and get it back in the evening. So that is also fraud, no? I mean, what I am telling is that. But anyway, there are certain situations where people make excess payments, but it can be made good during the day. Then no one talk on these things, no. But it can happen. That's a type of a settlement which can happen. But if it is a fraud, say, if it is been done intentionally, then it is a fraud. You get my point? Now, one can say that I have made a mistake and I got it again. So that's a fraudulent activity actually. But there are genuine cases. Say, for example, you make a excess payment. I mean, you owe payment to a certain person. Then now, when you try to balance the cash, you find that you have about, say, 100 million or so, sorry, a small amount, 1 million short. 1 million short. Then you know whom you make the payment, and you went there and you just got it from that person. So that's a type of a thing which happened, but it was a genuine mistake. It was a genuine mistake. If it was a genuine mistake, it's okay. But even though it's a genuine mistake, the audit can find fault with you if you don't report, right? So that can happen. But I think your question is whether it has to be reported as operational loss. Is that the case?
Yes, sir. That is the case.
Yeah. No, anyway, in my opinion, that is my opinion, right? It's, in my opinion, so if it happens that way, if it is a genuine thing, say you made the mistake and you found the mistake and you just identified the person also, and you went there and you just got it back. In my opinion, I don't think that it has to be reported as an operational risk, because you really sorted it out at the very low level, no? Because it's a mistake, but you really, I mean, mitigated it. But if it is not a genuine thing, then it has to be taken as a fraud.
Yes, okay, thanks. Understood.
Right. Right. Now, what I want to tell you is, now this loss database will give you a very, very important database, because you can really see the risk profile of the organization. Because at the end of the day, say, we can have this loss data reporting for, say, 5 years, like, then when you have a 5-year database, you can get a fair amount of data into that database. And you can see business line wise, what is the total loss and what is the frequency, and risk event type wise, what is the total loss and frequency. Likewise, you can get several amount of data. So that data will give you a so much good idea about the risk profile of the organization. So that is the very nature of this internal loss data. Right. With that, I think I can just go to the next presentation. Right. External loss data. Now, this arises because when you have a internal loss database, after 5 years even, sometimes you might find some empty cells in that. Now, as I told you earlier, if your organization also have 7 risk event types and 8 business lines, but I don't think that this is a hard and fast rule, but organizations to organization, the business lines and risk event types can be different, but standard level business lines, there are 8 business lines and 7 risk event types. Now, if that is the structure, then you will have 7 into 8 or 56 cells into that loss data base. But after even 5 years of data accumulation, you might find empty cells. So what does that mean? If you find empty cells, and can you say that there won't be any loss of that nature or no, any operational loss even in the future? You can't say that. So therefore, if you have that type of empty cells in your loss database, that doesn't mean there's no operational loss of that nature into your organization, because it can happen in the future. So therefore, we need to have external loss data in order to get an idea about the reality of such type of risk. That is why we go into external loss databases, because our data may not be sufficient for us to take decisions on our operational risk events. So in order to have a supplementary type of data, we should go for external loss databases. Now you can just see the reasons, the key points on external loss data. Loss events that have occurred outside the firm can provide valuable insight. It is not happened in the firm, but it is outside the firm. It could give so much of insight into any potential type of events, and normal external loss databases, they just go through several type of legal, regulatory, and other type of reports to provide analysis and to categorize operational risk events. Now there are databases called consortium databases. They collect data from members and share trends and benchmarking information with members. But in that case, the methods of collecting data also can have a certain biases. So in order to look at these data and to validate this data, you need to have an idea about these collection biases. What do you mean by that? Now, when someone else collecting data, operational risk data, so that organization may have different preferences in collecting data. So then it will become a bias for them. So then they have more data on that. So that would not be meant as an operational risk, high operational risk for that area. But it really, that level of data they collected in order to fulfill their biases. Because of that, there's a small issue in this external loss databases. Now this will give you some inputs for your other activities. Right. I think this will give you a certain idea about external loss event data. First of all, you can look at the sources. You might have news articles, journals, and email update services. So these online sources, you can get external loss event data. Then you can have subscription databases. Now I have given here the different types of organizations who provide external data. There's a organization called SAS. These people, they provide data on external losses. Even IBM. Right. You can just look at this now. I think this is a real depiction of a database. Now say, this is with regard to a particular organization called AlgoFirst as at fourth quarter 2012.
Excuse me, sir, we can't see the presentation.
You can't see it. Wait. Right. Is that okay? Can you see that? Can you see the presentation?
No, sir.
You can.
No, still not, sir.
Can't say.
Is it okay?
Yeah, it's okay, sir.
Right. Now we can just see the database of a particular organization as at 2012 fourth quarter. Now event types are given here: business disruption, clients, products and business practices, damage to physical assets, employment practices and workplace safety, execution, delivery and process management, external fraud, internal fraud, grand total. Now these are the event types, but they have not given it in one matrix, but they gave it in two different matrices. Now here you can see agency services. Now these are the business lines. Agent services, asset management, commercial banking, corporate finance, payment and settlement, retail banking, retail brokerage, and trading and sales. Now you can just check it. No, I will just go into this one. Now you look at this event type, business disruption and system failures. You can see losses as this amount, that is 5,941,530,424, and they have 113 records. 113 records. And it is, now when you have the all risk given types, it is only 1.54% of all risk given types. And there are 113 records. Now I think you get my point. There are 113 records of business disruption and system failures loss. The total losses are given as this, and it is, the grand total is this much. It is only 1.54% of the grand total. That is what it says. Then when you have clients, products and business practices, there you have very much, 46.11 of total losses. So that means the highest operational losses are in this particular risk event, clients, products and business practices. Then you have 3.18 and 26.20 here. And here you can see percentage of losses. Average. That means in one event, the highest loss. Now this is 19.22, so you can have that as the only 3.18 if you in record wise, but for each record it has a higher level. Average loss is higher. But if you take the next one, there you get the business lines. But in my explanation, I have given a certain loss database. You have both in one matrix. Both in one matrix. I don't know whether you can imagine a particular situation where you can have the both. Both means now you need to get the relevance with the business line and the risk event type as well. But here it was done separately. The event type analysis, one analysis, business line analysis, another one. So this is not the one I told you. Anyway, we will see whether we can have that type of a thing. Now it is the way. This is the way. Now this is the loss database which I refer to. Now say internal fraud, corporate finance. Now here they have given the business lines into the vertical, whereas risk event types given in the horizontal direction. That's okay, no issue. Now you look at this. And if you look at the corporate finance and internal fraud, you will find here nothing happened. Nothing happened. No losses at all. Now when you say ORX data, what do you mean by ORX? This is given through an exchange. I mean, this is a consortium database, we call it. Consortium database. Through a consortium database, this database was really arranged. And as per that database, you will find zero risk, zero in corporate finance internal fraud. So that means in corporate finance business line, no internal frauds happen during a particular time. If you go to the next one, that is trading and sales, in the internal fraud In trading and sales, it is 0.1% internal fraud. It is 0.1% of total losses. And as a number, it is 1.6% number of events. Now, total of number of losses here you have. Now, if you look at these things, if you take this one square, it is been divided by this diagonal. The upper part is looking at the loss. Lower part is looking at the frequency. Now you can see total number of losses, total amount of losses. Now, is it possible for you to analyze this database? Now you can just look at the bottom row. There you can see total number of losses and total amount of losses. Number they have given in the upper part, no? Yeah, total number of losses, upper part. Right. What does it say? Now I will just go into example. Now I think all of you can see the internal fraud column. Internal fraud column. Now, if you go into the internal fraud column, you need to go down. The further down and the bottom line. Bottom line you have corporate items. Sorry. Corporate finance, yes. Corporate finance. Then you have total number of losses and total amount of losses. Right. There you get 3.3% and 4.4%. 3.3% and 4.4%. What does that mean? The meaning is under internal fraud, you have number wise 3.3% events. So if you get the total number as 100, you have internal fraud events 3.3. And amount of losses. If you take the total losses as 100, you will have 4.4 losses in internal fraud. You get my point. Is it okay? Because you should be in a position to read this matrix. You should read it properly. Now, in order to read that, you should go into these lines, the final lines. At the bottom, you have a line, and at the top right side, to the right, you have a column, and in the bottom you have a row. And you can see under corporate finance, if you take the total loss events as 100, you have only 0.9 under the corporate finance, and loss amount is 8.8. Then when you go to the trading and sales, you have number 10% and 16.5 loss amount. If you go to the retail banking, you have 57.9 events. So that means if you take the total events, 57.9 events came from the retail banking. And as amount of loss, it is 46%. Retail banking. So that means this particular consortium really refers to more retail banking type of data. That is why you get this type of a reading. And you can see, if you take a risk event type, the highest losses reported on clients, products, and business practices. It is 54.2 amount of losses. And another 24.6% reported from execution, delivery, and process management. And you can see those are rounded in red. Now, with this ORX database, you can say the higher level of risk is in retail banking and clients, products, and business type, and execution, delivery, and process management. Now, these are the places in which you can observe higher exposure of operational risk. That is the conclusion you can go into with this ORX data. You can take your own time and just look at it and see what is the real meaning of it. Because this is what I need. Even in a bank, you can have this type of metrics. And in this matrix, you can see altogether there are 56 cells, because corporate finance up to this thing, there are 8 business lines. They have 10 business lines, of course. Private banking, corporate items, they said. Because their categorization, they had 10 business lines. But anyway, even for any organization, there's no hard and fast rule to say that you should have so much of business lines, but that all depends on the organization's requirements. So therefore, the separate organizations can decide on separate business lines. And even you can have your own names for the business lines, not the same names you need to use. And there's another graph given on that. These are the different comparisons coming out from that database. These are the issues of external data. As I told you, the reporting bias would be there. We don't know the relevance and the data quality also. These are the issues of operational external risk databases. These are the benefits. Now this gives you certain type of news items with regard to certain organizations. Now this is an analysis of a particular bank which we call Society General. Now this particular thing I am not going to discuss now. But what you need to do is you need to go through this, and I will just ask some questions on this later with regard to the operation risk events. Now I think it is easy for you to just look at this database and see in what form we are going to make use of this data to get what type of information. Now, for example, there are 3 rounded places, and this one, it is coming under retail banking in the horizontal line, and it says 57.9% and 46%. So what is the meaning? Real meaning is you have in the total loss base 57.9 in number and 46% in value of retail banking. So that means in all operational risk data, when you have a number of events, the 57.9% of number of events are coming from retail banking. And in the loss value, 46% of the loss value is coming from retail banking. So that means in this particular chart, retail banking is the highest operational loss maker. If you go into the risk event types, value-wise, the highest contributor is clients, products, and business practices. Value-wise. Number-wise, execution, delivery, and process management is the highest contributor. So that is what you can say by going through this data. Right. We will have a break now. And by 10:30, we will start again. Till that time, you can just familiarize yourself with this database, because it will give you a certain understanding, and for our future things, this will give you a base, right? So therefore, you better get yourself familiarized with this database. Right. Coming back to the session. We discuss about internal loss data, external loss data, and other things, where we have to put our base on basically the policies and procedures. So now we will try to see the underlying policies and procedures with regard to operational risk management. How are we going to do it? Right. Now our discussion goes to the policies and procedures on operational risk management, and that will be the base for operational risk management. And we just discuss about the initiation of practices through loss data. But whatever it is, we need to base our things on policies and procedures. Now, that should include the definition of operational risk, the governance, and who owns it, what it owns, and how issues are escalated. And the main activities, elements that are managed by the operational risk function. So these are the things which the policy has to state. Now, there are some characteristics of a policy given here, and it should be a realistic one, not an aspirational one. So the meaning here is, when you say aspirational, it is really a visionary type of a thing, but it is not really visionary. Operational means it is operational. So therefore, you have to be realistic. You have to be practical. And this policy has to be, it should be in a position to put into practice. That is what it means. Each element of the framework must have written policies and procedures against which the firm is audited by its internal audit department. Now, the real requirement here is you need to have written policies. You need to have written procedures. When an audit is done, the audit is done by looking at the written policies and procedures, and whether the policies and procedures are followed. That is what the audit is concerned. Therefore, the basic document should be there. And there can be standards into the procedures, and it should outline how activity should be undertaken. And it has to be explained, the step-by-step task to be explained. And there can be guidelines also. Now, even it is not mandatory, in most of the policy documents, guidelines are given. So these are the key points where the policy document say if you are going to start operation risk management unit in your organization, the first thing you need to have is to have a policy framework and procedures in order to do the operation risk management correctly. So then it will give you the guidance. It will give you the outline. Now, though we have this discussion, I think I will give you an assignment in terms of credit risk and operation risk both. And under the operational risk, it would be probably writing of a policy to your organization, and I think I will be in a position to give you a guideline of a policy document, a specimen, but you should have your own policy written, taking into consideration the requirements of your organization. So that would become one of your exercises or assignments. So it is not that you just get the things from the specimen policy I give, but it is only a guideline for you. You need to write your own policy, and I can just gauge whether you have done the correct thing, or if you are not done it correctly, then you would not get marks for that. So therefore, you try your best to see how you can write a policy, operational risk management policy and procedures for your organization. Though it is an exercise, you can make use of that in order to get a good understanding about your organizational practices. And interpretations meeting those requirements or regulations and all, and objective goals to be provided. But I think you can see there should be standard templates, minimum contents, approval processes and all. Because the policy is being really approved by the board of directors. So therefore it is the highest level document you have to follow. Now there's a definition for policy. It establishes minimum requirements and controls to address business strategy, compliance with law, rules, regulations, mitigation of other identified risk. Policies must be actionable and enforceable. Now this is a policy definition given on a policy. And procedures also. Procedures are specific instructions for implementing a policy or performing a task, and may include such things as examples, scenarios, links, jump backs, and all that. Now you can see the difference between policy and procedure. Procedure are guidelines, like, or not only guidelines, the specific instructions for implementing something. And it's a type of a task implementation, performing a task. Standards are also very important here. It sets the minimum requirements that need to be met. Guidelines also It's a supporting type of a guidance. Now you can see this hierarchy of policy document in which level the policies are existing. Now you can see the topmost layer is on regulations. Regs means regulations. The policies are really drawn taking into account the requirements of regulations. And regulations are really imposed. And with that enforcement of regulations, the policy is to be there in order to comply with all these regulations. And there should be a accepted practice which has to be given to the organization. And at that level, then the standards come. Because in order to have a policy, there should be certain standards in the procedures and guidelines. So you can see the hierarchy here. Sometimes we just identify these things at the same level, but it is not so. Policy will have the highest level document after the regulations, but then you have the standards and procedures. But guidelines are in the ground level. Now, these are the best practices with regard to a policy. In a policy document, you will find standard templates. Oh, sorry, the policy has to be in a particular format. That is what you mean by a standard template, because the policy cannot be a normal document. It's a specific type of a document with certain standards. And it should be indexed and searchable, central repository for the documents. And there should be a version control. What is the version? What is the type of volume or whatever it is? It should be there. Some firms allow regulators direct access to their policy portals. Now in most cases, you have internet portals or portals for policies. All the policies are available with a certain index in that portal. Now the policy approvals are being made according to the governance structure. Now basically in a financial organization or a bank, the board of directors approve the policies. Now when an organization has policies for several type of activities or policies for several business areas, and it provides evidence with regard to the strong governance. When strong governance is there for all of the business activities, all of the other activities, there should be policies. Publishing policies, standards policies, and procedures will depend on the culture of the firm. So, if a strong culture is existing in an organization, people have a regard for this. The employees will have a regard for these policies. Now we can be particular about operational risk policy. Should be approved by the board. Should include firm definition of operational risk, approach to operational risk governance, description of main activities and elements of operational risk. It should not be aspirational. Clearly state roles and responsibilities. The policy might also include. Now, this will give you a guideline for your exercise, because you are going to write a policy on operational risk for your organization, because it is an organization specific type of a thing, the policy. The policy might also include information on each of the elements of the program. So these might be covered in lower level procedure documents, guidelines and standards. Now you can just see the different types of guidelines which can come in the policy, procedure documents. Loss data program, that is a loss data capturing program, risk and control self-assessment program, scenario analysis program, key risk indicator program, validation and verification of activities, and capital model. Now these are the basic things which operational risk management policy should have under the guidelines. Right. Now, I'm just going to ask you a question. These are the guidelines for an operational risk management policy. What are the types of worries you have with regard to this? Are you in a position to do that? Because I will be able to give you a document, a specimen document of operational risk management policy. So with that, you should prepare a policy for your organization. But my specimen, you can't really use it to put the operational policy into the real form. But what it's only a guideline. You need to prepare on your own. Yeah, I like to have your own ideas with regard to that. So I think you can do that, and you will really get it into yourself, and you can give the lead, or you can get the leadership of operational risk management in your organization as it is. Right. I like your comments. Yes.
Yeah, that's better if you can give a guideline.
Yeah, I will.
So then
I will give.
Yeah. Then we can elaborate and see what we could do.
Yeah. Now I think this particular presentation really provide you some guidelines, but in addition, the specimen I will give you. But
okay, thanks.
That doesn't mean that you have to write the same thing there, but you need to take the guidance from that specimen, and you have to write your own policy. Now that policy to be written, having in mind your organization. It is for your organization you are going to write it, right? I think in your organization also there's a operational risk management policy, but you are not going to go through that. But as it is, you have to write on your own.
Yeah, thank you.
Right. Then I will go to the next presentation, that is on operational risk appetite. Operational risk appetite. We see. Now, this is a little challenging and confusing type of a thing where it is very difficult for us to have an idea about operational risk appetite, because the quantification is a little difficult. But anyway, we will see what we are going to do about this operational risk appetite matter. Originally, the Basel didn't offer so much of explanation on operational risk appetite. But recently, the regulatory requirements really focused on appetite of operational risk. Some of the risk actually the organizations are not really tolerating. So they say the appetite is 0 for some of the risk, some of the operational risk. So that is what the organizations are really taking those things into consideration. Now, the main responsibility goes to the board and the senior management to set, approve, and monitor risk appetite. Now, what do you mean by that? Set, approve. Set means now the level of risk appetite is a matter of it is to be a matter to decide by the decided by the board of directors, because board of directors are the owners of the organization and they need to articulate what is the level of risk they like to take. That is what you mean by appetite. But when you talk in terms of appetite, there are another terms coming in together with the risk appetite. Now, the two basic things which comes together with risk appetite is, one is the risk tolerance, the other one is the capacity. Now, I think this is a very important concept to be discussed. Now, appetite in its literal meaning is the amount you like to have. That is what you mean by appetite. Even when you talk in terms of appetite for some foods, like you like to have something up to that level. Appetite is that. But when you talk in terms of capacity, capacity is the full amount where you can bear. So therefore, it is invariably higher than the appetite. Because when even whatever the food you eat, when you eat it, then your hunger goes away, then your appetite now, then you are not going to eat so much. But if you want to have something, you can, higher than the appetite. So the capacity is that. Capacity is the full amount where you can bear. But appetite is little lower than that capacity. And there's another thing called tolerance. So the tolerance means now even sometimes you like to take some risk, that is the appetite. But tolerance means if the risk is little higher than that, you can tolerate. But there should be a level for that. It is beyond, or we can say it is little lower than the capacity, tolerance. Now, if you don't tolerate, but it comes to your capacity. So that means now, if you put it in a hierarchical way, you can put it this way. Capacity is the highest level. So that is the highest level of risk you can have. Tolerance is the second level. Then the third level would be appetite. So I think you got my point. Appetite is the level where you can take or you like to take with your with your consent you take it. But when you say tolerance, tolerance means which is little higher than the appetite tolerance. But they are also, if you are not tolerate, even without the tolerance, you can go beyond that up to the capacity. So therefore, you can say highest level is the capacity, then the tolerance, then the appetite. Now you can just see what is the role of risk appetite. Operational risk management, measurement, and capital modeling produce data scores and capital numbers that are designed to be used by the firm to identify, assess, monitor, control, and mitigate operational risk. Now what we need to understand is it is an inherent type of a risk. You can't really avoid that because it is there. It is inherent in all operational activities. Now, risk appetite usually matures as the operational risk program develops. The meaning is this. Now, when you have a proper program for managing operational risk, your appetite might go little higher. But only thing is now in operational risk, though this appetite comes into your mind, but the operational risk will not give you any return like any other type of risk. Now, in order to just have an idea, so if you take market risk, that risk you take in order to have a return. But operational risk is not that so. It is not that way. So operational risk always put you in trouble. Therefore, the appetite, because if you do not have an appetite to take operational risk, then you can't do business. That is the issue. But that business is not done with the intention of getting a return. But if you bear credit risk and market risk, that is for really having a return. But for operational risk, it is not the case. But you need to have a risk appetite for operational risk. Why? Otherwise, you may not be in a position to operate your business. That is the issue. So therefore, for ease of doing business, you need to have a risk appetite for operational risk, for ease of having business. But if you don't have a risk appetite, then you can't do business. But that risk appetite you should not confuse with risk appetite for credit and market risk, because that risk appetite comes with an intention to earn profits. But here the risk appetite doesn't come with the intention of earning profits. It really comes with the intention of running the business, not earning profits. That is why we need to have a risk appetite for operational risk also. Otherwise, one can argue there's no necessity to have a risk appetite for operational risk because it doesn't give you any return. But the answer for that is risk appetite for operational risk should be there in order to operate the business. Now here the things is little different here, what I told you. But here the risk tolerance means the specific levels of risk by risk category. So that is what you mean by risk tolerance here. Now, in order to monitor risk, thresholds should be there, but those limits have to be lower than the risk tolerance even. Because these are the.
Can you take an example and just like explain those three elements in different categories? I think it's better.
No, it's like this now. When you say risk capacity, now that really comes with the capital. Now, when you say you have a particular amount of capital assigned for something, operational risk, so our capacity is that, then we can go up to that level, the risk, operational risk. But when you say appetite, that is the amount we like to take. Like to take in the sense, now for example, we know that we can expand our business. We can have so many branches. Now the bank, when the bank wants to have so many branches, bank knows that our operational risk exposure would go up. But to what level it would go up? So that is what you mean by appetite. So we like to have that particular risk exposure. We like to have that. But only thing is, we have to, even though we like to have it, in the organization itself, there should be some guidelines given with certain limits, and those limits are lower than the risk appetite levels, because since it is we have to put it into all over the organization, so we have to put it as limits, and the limits have to be lower than the risk appetite. So then, in a very rare situation, it really go beyond that. So then, even though it goes beyond that, we are in a safe level. So that is what it means. So then you can just put this hierarchy into your mind. So now it's like this. Now when you prepare limits, when you just give the limits to different divisions of your organization, those limits really depends on your risk appetite in the first place. Your risk appetite depends on your capital, your capacity, because you know the capacity, and then you have a mental picture of your appetite. But when you put the limits, you put the limits in at a very lower level than your appetite. So that is how it is being done. Now, for example, say you have a risk appetite of say 100 million. But when you put into the branches and the organization, the limit is not that. It is a lower than that amount. Say it is 80 million. 80 million is the limit given to the branches or the ground level. So then what happens? When it goes beyond that, there is a particular tolerance level where you can tolerate. But if it goes beyond that also, it is come up to the risk appetite. But anyway, you have time to deal with such situations when it goes beyond the risk limits. Because of this particular limitations, you can manage the things well. So then this is only a type of a concept where we can make use of, but through that concept only we arrive at risk limits. That is what I can tell you about this these words: appetite, capacity, tolerance, limits, and all that. So you need to keep in mind that risk appetite is a virtual type of a thing. It is not in writing somewhere, but it is virtual. But this particular risk appetite has to be quantified to a certain extent in your ICAP document. That is what I want to tell you. In the ICAP document, it comes. You have to quantify the risk appetite, and through the quantification of risk appetite, you have to give other things also. Risk tolerance, what is the tolerance type of a thing, and limits. But in the organization, most important thing is the limit. So therefore, in the policy level it comes. The risk limits will come in the policy level. So when it is been given, the limit requirements are really calculated with the intent, with the taking into consideration the risk appetite. That is how it comes.
Excuse me, sir.
Yeah.
When we the limit, when we consider the limits,
Yeah.
now this is how we consider the external factors. For
Yeah,
example,
of course, yes,
now
yes.
the industry NPL has
Yeah.
gone up.
Yeah.
So that is we have to consider when the risk tolerance and the limits. No.
Yeah, yeah, of course. External factors are also to be considered. But only thing is now you are not going to change these things frequently.
Yeah.
That is the thing. You can't change the things frequently. Now, as it is, this is not risk limits as now. Are you referring to credit limits or whatever? So it is not
Yes.
so. I mean, it is different. It is very much different from that.
Excuse me, but sir, even in credit limits, that now let's say we have an internal directive or circular which will be clearly mentioning about those limits. So when we prepare the directive, even that will this risk appetite and the risk limit will also be considered. No, so even that also comes to a broader framework. No, is it?
Yeah. Correct. But here the things are little different because now as it is now, that's what I told you earlier also. Now for market risk and credit risk, we have the risk appetite, and we have that appetite, and we have all these risk bearance or whatever. We do it with the intention of earning returns. That is our intention. If you don't take that risk, we will not be in a position to get a return. But unlike of those situations, in operational risk, what happens is we are not going to take operational risk to get a return. Right? Get my point? No, we will not get any return from operational risk. But we need to have a risk appetite for operational risk. Why? If we don't have a risk appetite for operational risk, we are not in a position to do business. We are not in a position to run the business. In order to run the business, we need to have that appetite. So therefore, the limits and all sort of things are not being created on the basis which we did it for the credit risk and market risk. These are separate type of a risk limit indication. I think you got my point, because though the structure seems to be the same, but it is not the same. Because what I want to tell you is the risk appetite for operational risk is with a different intention. That is the issue. You got my point. Now, in operational risk, when you take in terms of risk appetite, when you consider in terms of credit risk and market risk, intentionally, we have to bear that risk. That is why that risk appetite comes. Why? We need to get the return. In order to get the return only, we do that. But in the case of operational risk appetite for operational risk comes with not the intention of getting a return. Because operational risk will not give you any return. So, but if you are not going to take operational risk, there's no way of doing business. There's no way of operating your business. That is why you have to take operational risk. There should be an appetite. I think you got my point. It is not same as having a risk appetite for credit risk and market risk.
So, what are the items?
You got my point, huh?
Yeah, what are the items we have to consider when we are setting the risk appetite for operational risk? That means is that that the internal loss item.
Yeah, of course, yes. Now we can talk in terms of internal losses, and not only that. Now, say for example, when you want to expand your business, say you want to open more branches if you want to open more branches, you know invariably you have to have higher operational risk, right? So then you think, what is the operational risk you can really bear? Say, for example, you got the approval for opening of 3 branches, right? 3 branches, but you at a later stage you might think that your risk appetite is not so high, because then we are not going to open 3 branches. We only open 1 branch. They are within our risk appetite, because even though we open that branch and we do the business, our operation risk would go up, but up to this level. Then we better not to open the other branches. So likewise, now that is the way it has to be done. When the limits are being given, now it is not as that's what I told you. Though we say that risk limits are given, we given it a more qualitative nature. The risk limits are given at a more qualitative nature than credit and market risk limits. So that is the difference here. I can give you a small document for that at a later stage. Still, I don't know whether you got my point, because I have not seen several documents on risk appetite with regard to the operational risk in Basel documents. It is a new concept actually, because people really found it very difficult to have very quantitative limits on operational risk, because it is very much difficult for you to quantify operational risk. That is the issue. But anyway, the limits are given in a more qualitative type of a nature. That is the only way I can explain it. Rather than just credit and market risk, we can say in rupee terms you can give the limits. But in operational risk, we can't give limits like that. That's what I told you. We can say our operation under our operational risk policy, if you want to expand business, right? So that is one way of doing giving the limit, right? If you want to expand our business, we should not open more than 2 branches per annum. So there is a limit. And you can say what type of branches you need to open. So these are the types of limits given under operational risk. It is not as credit risk limits or market risk limits. I think you got my point.
Excuse me, sir. Now let's say like this. Now let's say we are going to give limits for a teller, right? Now let's say we have a hierarchy, and based on the hierarchy, we give limits for based on the hierarchy. Let's say payment limits, right? I'm taking a simple example. In that case, now again you can quantify that, no? So
of course.
Now So
right,
again, then
that is also correct. I mean, in some cases you can quantify, right? Now in a teller's case, it's okay. And the other thing, right? You are very correct of I mean, putting that example. Now say, for example, say tellers are doing transactions. Say now normally if a teller is doing so much of transactions per day, say 500 transactions per day, then there can be high operational risk. So then you can give limits for tellers also. I mean, number of transactions even. So that is what you mean by risk limits in that particular level. In such cases, you can give a certain quantity, as you pointed correctly. So that is okay. That there you can have limits that way. But there are some situations under operational risk, you can't have that type of quantitative limits. Now, your example is a correct example for that there we can do that. But in some cases, you can't do that. Now, that's what I told you, because operational risk is a very peculiar type of thing where you have to be very careful, and quantification is very difficult. Now, when you say, now I am just getting the example of opening branches. When you open more branches, you will have to face with more operation risk. So then you have to say, per annum, the bank is not going to open more than 2 branches. So likewise, so that is another type of limit statement. So that's what I'm telling. So such type of statements to be made with regard to operational risk. Now, as you explained correctly, that the teller limits and all, so those things actually okay. Those are really limits. Those can be quantified without much issue. Now, as it is now, say in a dealing room also, you have such limits. No, dealing room, you can say overnight limit. So those are limits. Those can be quantified. But they are also, that quantification is basically done not only for operational, other risk also, the market risk also, that those limits. Now, say for example, this overnight limit. Overnight limit, there's a thing called overnight limit, no? So overnight limit given because now that's a control of market risk. It's not operational risk. But if you don't follow limits, then it is a operational risk. You got my point? So that's really not operational. It's market risk, basically. So therefore, for operational risk management, the quantitative things are little vague, but you need to put it in more qualitative form. You can actually get more details on these things, because I think that's a type of clarification you need to make. Only thing here is you should really demarcate the difference between operational and other types of risk. Operational risk will have a more qualitative form, because the quantification is little difficult for some type of things. That is the issue. Now here you can just see the next slide. You can say, now regulatory expectation, you get the point here. The regulators have evolved their thinking on risk appetite not just in operational risk, but as an important element on corporate governance. So that is what they put in. But there they have not mentioned about the appetite. Now you can just see here in the principle 4, approve and review a risk appetite and tolerance statement for operational risk that articulates the nature, types, and levels of operational risk that the bank is willing to assume. Now there are also the nature, types. Those are important. But in some cases, you may not be in a position to give a real quantification, but you can give the nature and types. Now you can see the audit concerns here. They should review the robustness of the process of how limits are set and why and how they are adjusted. So as it is, I really accept that what you have said, because you said that in some cases that tellers have certain limits, some dealers have certain limits. So those things are also some appetite, because the particular organization likes to take that. That is why you have that type of limits. That is correct. But in most of the time, operational risk appetite is devised in a more qualitative form than quantitative, more or less qualitative. Now you can just see the differences here. These risk appetites and all, more or less, we will go to another type of section where you can connect it into that. So we are going to talk in terms of key risk indicators, and the risk appetites are really being taken into consideration with key risk indicators in some cases on operational risk. So that's another way. So therefore, I think your question is answered there. In terms of key risk indicators, we can devise a methodology to have risk appetite limits or risk limits or something like that. So that would be there. Right. Anyway, now though we just go through this, there are several indications here, but I don't think that we can all go through these things. But you can leisurely go through these things. But the point here, what I want to make is, now articulating the risk appetite for operational risk is a little peculiar task than having the risk limits for credit and market risk. The reason is the operational risk is more qualitative, in a more qualitative nature, and we don't have sometimes it is not directly taken into consideration. So therefore, there are several issues with regard to the making of limits, but there are occasions where we can do that. And not only that, there's a thing called key risk indicators, and through the key risk indicators we can arrive at certain limits depending on the appetite. Then we can go to the next presentation. Have you got the things clear, or you need to have more explanation on that? Because it's an inherent issue. Everywhere you find this problem, because the risk appetite for operational risk is really a little issue, because the quantification is little difficult for operational risk. Even this will rise in business continuity planning also. Disaster recovery and business continuity planning, this particular issue comes. Right, now the next one would be a very important activity where a bank or financial organization has to do, and we call it risk and control self-assessment. Now, before going into this presentation, now I want to give you some type of details about this activity. And by going through the name for that, self-assessment, because it is to be done by the employees who are in the particular department or particular branch, not by the operational risk management division, but they can really guide them, give different instructions, give certain instructions, appropriate level of activities, and give the leadership. That can be done by the operational risk department, but the particular activity has to be done by the people or staff in particular branches and particular departments. But this is a challenging task. So therefore, it is very much important for you to select people who can convince the others about the importance of such program and inculcating certain opinion among themselves that this is a particular activity which we need to do, and it will really help you to streamline the processes and enhance the quality of the customer services. So if you can just convince that to the grassroots level staff members, then they all will involve in this activity and help to maintain these controls and assess the controls in order to enhance the quality of the controls. So that is what we need to understand. So therefore, if a bank can or organization can have this type of activities all over the organization by the staff themselves, then all would realize that we all are part and parcel of operational risk management. So that is what we need to convince the staff members. And it provides an opportunity to look forward. What could occur in the future? And it might come in many different forms, but you need to select the appropriate method. And it can be used to collect scores for the effectiveness of controls. There's a thing called workshop method. Now, I think in most organizations, the workshop method is used to implement RCSA. And there, the scoring is done through groups. And there's another method called questionnaire method. They have to use standard templates. But only thing is this RCSA, as I told you earlier, here also you need to face with the issue of the nature, the qualitative nature of these things. For the last couple of years, this particular activity got the real maturity, but then the organizations can change their ways of doing RCSA. Now, risk and control self-assessment, the name. There, you need to assess the risk which can arise. Not only the risk you are going to assess, controls also. you have to assess the controls also, not only the risk. Identify, assess, monitor, control, and mitigate events that have not yet occurred. Lost data look backward. RCA looks forward. Now, this is actually now the comparison is made between lost data and the RCSA. Now, in RCSA, what we need to do is, first of all, you need to have a discussion with the branch or department people. And in the discussion, you have to get an idea from the people who are in the department or the branch with regard to their main functions. And all these functions will have a set of processes. And you have to identify these functions, and all functions to be described with different activities or different processes to achieve the function. So that is the first exercise with regard to the RCSA. So the department people or the branch people will document these things. That's the first activity. Now here the risk and control self-assessment, really it is subjective, and scoring of risk and control reflects not the view of a third party but the view of the department or business itself. So that is the main activity here, because people in the department or branch, they do the assessment. Therefore, it is a subjective one. Now, basically, though we have had a slide show in this way, this is a more practical thing actually. Now, if all of you try to do it in an organization, you have to select 3-4 persons who can convince the others with regard to the importance of this activity and give the guidance. Then at a later stage, the department people or the branch people themselves will do it. There's a documentation part also, where you have to document the functions and the processes which you have to follow to achieve the functions, fulfill the functions. That is the first part of it, where some documentation is required. Then you have to have a scoring sheet or whatever, and then the scoring will give the level of risk you can understand, and the control effectiveness also can be understood. Now, as it is, there are 2-3 methods of RCSA. Now, There's one method called questionnaire approach. The other one is workshop approach. I emphasized on the workshop approach because the group setting is there, facilitation is there. And that's what I told you. First of all, the group prepares the list of functions. Then each function is described with different steps to achieve the function. And afterwards, we have to go by each and every step and find the risk of that step and the available controls to mitigate that risk. So this is the way you need to do it when you do the workshop approach. But in the questionnaire approach, there should be a template. And there are standard risk and control questions. And as per the answers, there can be a level of scoring. So that is how the questionnaire approach is being done. But I suggest or I recommend the workshop approach than the questionnaire approach, because in workshop approach, you can do both two things. One is you can do the RCSA, and at the same time you can inculcate a certain operation risk culture into the minds of the people who engage in this activity. These are the disadvantages and advantages, but I am not going to discuss on these things, and it takes so much of time. Now, if you take any function, and there are different processes or different steps of things where you have to do in order to achieve the function. So for each step, there can be a risk and controls. Now, when you say risk, there can be inherent risk and even residual risk. So when you talk in terms of risk, what sort of measurement we are going to make? For a risk, in order to measure risk, what we do is we first go by the impact, not only the impact, the frequency of it. Both things has to be taken into consideration to have a assessment of risk. Impact and frequency. So when you say impact and frequency, and in order to get the level of risk, we need to arrive at the impact of the risk and the frequency of risk. When you go to the controls, control effectiveness is really evaluated through how the controls try to mitigate the impact and the frequency of the risk. So the controls are really evaluated in that basis. Now, in order to get the control assessment, it is assessed on the basis of design and performance. Now, what do you mean by that? A control has to be designed that on a certain basis. And the performance means how it is performed to control the risk. Now, when you say design is low, the design provides only limited protection when used correctly. When it is medium, it says the design provides some protection when used correctly. If the design is high, we are here referring to the controls. The design is high, that means the design provides excellent protection when used correctly. Now, it is really in terms of protection you are talking about. Low, medium, and high. When the protection, when it is used correctly, the design is used correctly, it gives only a low protection. Then it is low. When it is used correctly, when it gives a medium type of a protection, some protection, then it is medium. But if you use it correctly, when you get a very high, excellent protection, then it is high. Now, when you go to the performance part of it, the control is rarely performed. Even though the control is there, it is not performed. Then it is low. The control is sometimes performed. Sometimes the control is performed, then it is medium. The control is always performed, then it is high. Then the control scoring, the strength of the control is taken through a particular score. The scores are given on the basis of design and performance of the controls. And that will have a color code to give the assessment. So you can see when the design is low and the performance is low, it is red. The risk is high. If the design performance is low and the design is medium, there also it is risky, it is red. So you can just see the color code. Now, when you have a high performance and high design, then you are in the green direction. So that is the low risk level. So likewise, you can have a qualitative evaluation for the controls. Then for risk impact, you have this type of a criteria: financial impact, reputational impact, legal or regulatory impact, client's impact, or safety impact. Because that can be quantified. That can be quantified. Then you can just see the frequency of those things. The frequencies are really taken into consideration on an annual basis. Now here, if the event is likely to happen 5 times in the next 12 months, that means the probability would be 5. Or the frequency would be 5, we call it. So per annum level, we put it. And if it's likely to happen only once in the next 10 years, then it would be 0.1. So there you have low means once in 5 years. More than once in 5 years or once in 6 years. Now, if you if it is happening once in every 5 years or more than 5 years, then it is taken as a low frequency. If it happens once between 1 and 5 years, it is a medium one. And if it happens more than one time per annum, then it is a high frequency. Then for a risk, we do the analysis taking into account the impact of the risk and the frequency of the risk. Now, mitigation is done on the basis of risk severity. Now, when you have a rating category as low, then there won't be any mitigation taken into account because it is low. Then if it comes as medium, severity may be a concern, and high, it is a concern really. So that likewise now, though you have you said that there's a scoring method, but no scoring. The only thing is now these color codes are given. Those are the equivalent of scorings. Now, in order to do this RCSA, as I told you, in the group level activity, the group has to document the functions of the branch or the department. These best practices are given on the basis of a group activity. Now, though we call it a self-assessment, the operation risk department should give the leadership, and they have to convince the people also. Therefore, the operation risk department should have a person and persons who are capable of doing these things. Now, first of all, before going into the RCSA process, the participants to be interviewed, and you have to have a communication with them. You have to identify the strengths and weaknesses of those people, how we can get these people into the real process. And available data has to be reviewed from other functions. And of course, if they have done earlier RCSA, then we can review that. But as a guidance, what we can do is, if we can get hold of loss data, internal loss data with regard to the particular branch or the organization, particular department, so it is a starting point for your RCSA. And carefully select and train participants. Document results has to be documented. Then mitigating actions to be identified. You have to ensure the completeness later on. So anyway, I can just tell you something here. For example, say if you visit a branch to guide on doing the risk and control self-assessment, the first activity we should initiate is to get all the functions documented by the staff. So for example, if you go to a branch and ask them to list all the functions, they might come up with, say, for a branch, you can say payment of checks, accepting check deposits, granting overdrafts, opening current accounts, opening savings accounts. Likewise, there you can have several activities you can find for several functions. For example, say opening a savings account, for example, right? So this is the function. Now then you need to identify the steps. So you have to just talk with the customer. The customer would give you the mandate field, signature card field, then ask for the cash deposits, identification, then issue the book. Likewise, you have steps to be carried out in order to open a savings account. So then you need to just jot down all the steps from the interview, or interview in the sense you have to talk with the customer. The customer would say that I want to open a savings account. Then you would give him a form. Then he has to fill the form. So whatever it is, the way you do it, you have to put it. So that is how you can just indicate. So in the case of, say, opening a savings account, what is the risk? Getting the application from the customer. So there should be a control. Now you have to check whether all the things being filled up, all the information given. Then those are the controls. Whether the identity card number is correct, identity card is okay, whether the real person's identity card is there. So likewise, you have to check. So those are the controls. What are the risks? Risk is now the person can have a fraudulent account. That is the risk. Even with the identity card, the person can have a fraudulent account, impersonate. I mean, some other person's name, he can open the account. So these are the risks. So likewise, I'm just giving an example. So that has to be documented and see what are the controls available to mitigate such risk. And those are called inherent type of risk. These inherent risks can be reduced by applying controls. But though you apply controls, you cannot get rid of 100% of the inherent risk. Through the controls, you can get rid of some portion of it. So even though you get rid of some portion, another portion would retain. So we call it residual risk. Residual risk. But if you go through the function and different steps to achieve the function, for each step, you have to assess the inherent risk and the available controls. Inherent risk can be reduced by applying the controls, but it would be reduced by a certain amount, a certain part of it. So even with the controls, there can be a residual risk. So, but the residual risk should not be as high as inherent risk. It should be a lower amount. But if the controls are not strong enough, the residual risk and inherent risk may be the same. There won't be any reduction of risk through the controls if the controls are not strong. If the controls are strong, what will happen? The controls can reduce a substantial portion of inherent risk, and remaining risk would be a lower amount. So then in that case, we call the controls are strong. That is how the control strength is being checked. Then you need to identify. There's a thing called inherent risk. There's a thing called controls for each step. And after applying the controls, the inherent risk can be reduced to a certain extent. And even with that reduction, another amount is retained. That amount retained is called residual risk. So this is the criteria in RCSA process. But we can just put a design here. I will next time I will give you a design of this, but anyway, now all these things will have a practical significance. Anyone who do it did it in your organization? Now, rather than a theoretical thing, this is an approach where everyone has to get involved. Now, anyone of you who engage in this type of activity in your organization? If you just look into these slides and all, you might feel now this is a very cumbersome type of a thing, but it is not so, because we have the experience of doing it, but we did it in say in 2009 we did it, 2009 and 10. At that time we did it. Anyway, later on the things were really very much successful. But in my opinion, I think that some of the organizations they follow this. Now, the internal control factors are very important in the case of RCSA. But and I think together with risk and control self-assessment, we have to discuss about key risk indicators also, because the questions on operational risk appetite, tolerance, and limits all can be solved through these key risk indicators. KRIs are used to monitor change in risk levels, and true KRIs are difficult to identify. Now, advanced measurement approach, this KRI is a more suitable type of measure. Now, when you talk in terms of a KRI, it should be specific, measurable, attainable, and relevant and timely. Now, I can give a small example of a KRI. Say, for a branch, you can say number of breakdowns, ATM breakdowns per week. Number of ATM breakdowns per week. So that's a type of a KRI. So then the question comes, what do you mean by a breakdown? How long would it be there? So likewise, you need to have that details also, but on the face of it, you can have it as a key risk indicator. Now, if you are talking about the branched ATM, you can say number of breakdowns per week. So that is a KRI. Now, as it is now, when we talk in terms of risk limits, like there's an appetite, say, if it is once or twice a week, it would be okay, like. So then we can say our limit, KRI limit is 2 breakdowns per week, or even one breakdown per week. Right? If you don't tolerate anyone, but you can't say that, one. So you need to maintain that operational level. I'm just referring to an example of a KRI. Number of ATM breakdowns per week. Your limit is 1, or your risk threshold is 1. If it is more than 1, then action is needed. Action is needed. So that is a particular simple example regarding key risk indicator. Now it really looks at the change in risk environment, not only internal, external also, external risk factors. Sometimes, though you get a good indicator, but that might give you a false comfort. Sometimes the red matrix can give rise to unnecessary panic. Another challenge is finding a metric that is truly measuring risk levels. Now, to get a particular KRI identified, before that, there should be a time through which you need to do an analysis and whether it is valid, whether it is valid as an indicator, valid as a key risk indicator. Till that time, we just say it is an indicator, not a key risk indicator. Right. This KRI thing actually this is also very practical, in a very practical nature. I think by now I have just browsed through the things, but not detail so much for something. What I want to just talk with you, because these are little challenging tasks where you have to put these things into practice. That is the issue. My concern is also that, because whatever the presentation, whatever the explanation, it won't serve any purpose. Only thing is, if you can make use of those things and put it into practice, that is the only thing my concern is that. So therefore, as you just talked with me earlier, the arguments or whatever, the queries, so that would be the most important thing, because otherwise you can leisurely go through these things without any issue. So anyway, now sometimes you might have come across several issues. So you need to clarify those things. Can we do that now? The rest of the time, we can have a question and answer session. Yes, anything. We discussed on loss data, internal loss data and external loss data both. And we discussed on RCSA, risk and control self-assessment, and the key risk indicators. Now the things are there in the presentation, basically, but you have to understand the concepts. Right, we can have a small discussion now. Brief discussion. You can come up with your own queries.
Sir,
Yeah.
So when we are setting the risk appetite,
Yeah.
credit risk, market risk, operational risk, all are depends on the availability of capital.
Yeah.
So how do we apportion this available capital to each kind type of risk?
Yeah, I think that's a good question, because when you really calculate the amount of capital assigned, you do it on the basis of credit, market, and operational risk. So there's a thing called risk-weighted assets for credit risk, risk-weighted assets for market risk, risk-weighted assets for operational risk. So this is a type of a method. No, I mean, that is what you call the Basel II Pillar 1. Under the Pillar 1, you do these calculations. The bank has to do that. Then you know, out of your capital, say, for example, you have 100 million capital. Out of that 100 million capital, what is the amount assigned for the credit risk? What is the amount assigned for the market risk? What is the amount assigned for the operational risk? In most of the cases, about 70% is assigned for credit risk. 70%. Another 15% is assigned for 15 or 20% assigned for market risk, or sorry, operational risk. Then another 10% is assigned for market risk. That is the normal way nature. But the percentages are not really coming automatically, but there's a particular calculation method given to arrive at the capital charge for operational risk. There are three methods now: basic indicator approach, standardized approach, and or so forth. You have that, no? So then you know what is the amount of capital assigned for operational risk. Is that clear? So through that, you can arrive at the risk appetite and risk limits. Is that okay? But the only thing is, now you have to apportion these things into different activities. So that's a type of a challenge. Overall, you can say operational risk this much, the capital. But you have to decide what is the apportionment for particular operational risk. So then the limit has to be taken into consideration. No? So there you have to see what is the portion. Now, say for operational risk, say you have assigned say 15 million, and you are referring to an operational risk, say you say number of so we can say a loss. Sometimes these loss thresholds are also calculated on the basis of capital, on the basis of capital charge for operational risk. So for example, say the operational risk capital charge is say 10 million. 0.01% of 10 million is the threshold, minimum threshold. So likewise, you can have that type of criteria to apportion these risk appetite levels.
So when we are taking capital, are we taking the excess capital than the statutory limit or total capital? In capital adequacy, we do have required minimum level. No? Are we taking the excess one, that means the buffer level, or the total capital we have to consider when we are fixing the risk appetite levels?
Yeah, risk appetite levels, actually what we do is, now it is like this. Now you can calculate the regulatory level of capital. And the available capital is there. No? When you have the available capital, you can apportion this available capital, the whole thing, into credit market and operation risk in the normal percentage. Now the percentages can be, you can arrive at the percentages through the capital charge for market risk, capital charge for operational risk, capital charge for credit risk. That has to be calculated. No, those calculated things are there. So what you have to do is, you have to get the total capital and apportion the capital into different percentages. And as you say, that whole capital can be taken into that.
So another question, there is a wording called risk appetite statement. Also risk appetite levels, both are same or two different things?
No, risk appetite statement is the statement where you can design and explain how you have arrived at these appetite levels. So that is what you call the risk appetite statement. Now, in the risk appetite statement, risk appetite levels are given. The statement is the particular document where the risk appetite levels are explained. Got the point?
Yeah, thank you.